Let's be real, the market is a sea of red right now. And if you follow fintech, the noise is just deafening. So today we're going to cut right through all that, get past the scary headlines, and really understand what's happening with a few key companies. You've seen them everywhere, right? Headlines like this are designed to grab your eyeballs and, let's be honest, stir up a little fear. With the whole tech sector getting hammered, it's so easy to get swept up in the panic and just assume the absolute worst for everybody.
But this brings up the most important question, doesn't it? Does all this crazy market volatility, all this day-to-day stock price chaos, actually mean the businesses themselves are broken? Or is there something else going on under the surface?
To get a real picture of what's happening, we're going to break down the recent earnings from three very different fintech companies. And trust me, each one tells a totally unique story about resilience, expectations, and what long-term growth actually looks like.
Okay, first up, Affirm. You know, the buy now, pay later giant. Their stock took a nosedive right after their earnings report came out, and on the surface, it looked like a classic case of a high-flying company hitting a brick wall. But let's dig a little deeper.
So this is where it gets really interesting. On the left, that's what drove all the negative headlines. They missed their earnings per share target. But then you look over to the right, and you see the real story. Revenue grew by 30%. And gross merchandise volume, that's basically the total amount of stuff people bought using their service, grew even more, by 36%. This is not a business that's falling apart. It's a business that's still growing like a weed. And check this out. This is the part of the story most people just totally missed. The volume on their debit card product absolutely exploded, surging nearly 160%. That shows you that customers aren't just sticking around. They are diving deeper into Affirm's world. That is a fantastic sign for the long-term health of the company. So what gives? Well, this wasn't some random miss. It was a deliberate choice. See, management is playing the long game here. They're pushing their 0% interest products really, really hard. And while that squeezes their profits in the short term, it's a super powerful move to attract and lock in a huge, loyal customer base for years to come. It's all about grabbing that market share now. So for Affirm, the business engine is still humming along just fine. The real issue? Wall Street's short-term expectations were just completely out of whack with the company's long-term strategy. Now let's pivot to a company with a totally different story, one built on quiet, institutional strength. All right, let's talk about Blue Owl Capital. Now this company is kind of the polar opposite of Affirm. This isn't some flashy consumer tech brand. They live in the world of private credit and big institutional investing. Their story isn't about explosive growth, it's about slow, steady, and frankly, immense strength. Now, to really get Blue Owl, you have to understand this one term, assets under management, or AUM. It's actually pretty simple. It's just the total pile of money they manage for their clients, who are usually massive institutions like pension funds. And Blue Owl's AUM is sitting at over $300 billion. I mean, just let that number sink in for a second. This isn't flighty, everyday investor money. This is the serious, long-term capital that moves markets. You think that in a chaotic market, this kind of big money would just dry up and run for the hills, right? Well, nope. They raised over $17 billion in new capital just last quarter. That is a massive vote of confidence from some of the smartest investors in the world. So why is this such a big deal? Because it tells a completely different story than the public markets do. While stocks are bouncing around like crazy every single day, this so-called smart money is making huge long-term commitments. It shows that major institutions see private credit as a solid, strategic place to put their money for the long haul. So yeah, the story of Blue Owl is all about quiet, methodical execution. It's a marathon, not a sprint. And it's powered by the deep, steady currents of institutional capital, not the choppy waves of daily market news. And that brings us to our third story, Bill.com. So if Affirm was about managing expectations and Blue Owl was about steady strength, Bill.com is the story of a clear, straight-up, undeniable win. They just delivered, plain and simple. Look at this. They didn't just squeak by. They comfortably beat expectations on both earnings and revenue. But here's the real kicker. They actually raised their guidance for the future. That's a company telling the market, yeah, we're not just surviving this environment, we fully expect to thrive in it. And when you peek under the hood, you can see the engine that's driving all this success.
We're talking about processing nearly $100 billion in payments for almost 500,000 businesses. This company is deeply woven into the financial fabric of the small and medium-sized business economy, and that creates an incredibly durable business.
And that's exactly why this performance is so important. It's more than just a good quarter. It really shifts the narrative. It proves that a business-to-business fintech model that's focused on essential services, well, it can be incredibly resilient and profitable, even when the rest of the economy feels shaky. Okay, so we've looked at three very different companies with three very different stories. Let's stack them all up now and get that calm, clear picture of what's actually happening beneath all the market noise. So here's the whole thing in a nutshell. With Affirm, we learned that a strong growth story can get buried under a pile of mismatched expectations. With Blue Owl, we got a reminder that the deep, structural flows of capital are often a much better indicator than daily price swings. And with Bill.com, we saw clear proof that a durable, essential business model can absolutely shine, even in a tough market.
You know, the key lesson from all this isn't to ignore market volatility, but to use it as a trigger. It's a reason to take a breath, calmly check your assumptions, and look at the fundamental data, not to panic and flip your whole strategy overnight just because of some scary headline.
And that really leaves us with one final thought. When the market gets chaotic and the headlines are all screaming at you, it's worth asking yourself a simple question. Are you reacting to the noise of the headlines, or are you focused on the signal from the fundamentals?